Hey, hi, sorry. Hello, welcome. Hi.
Hi,
Thanks, George, for your consistent commitment. Really appreciate you come in. Are you able to hear me okay?
I hear you fine, and
Oh,
thank you for putting on the webinar every week. So thank you so much.
no, it's fine. Thank you. Really grateful, that people are able to come. It's a summer. I recognize, people are busy. So thank you very much for your time. So got a couple of things I wanted to talk about. Just let me make sure. Yeah, that's fine. A couple of things I want to talk about. The first one was something that people wrote to me, asking me about GitLab and asking me about um, my when I downgrade a stock to a hold. So it was, for example, at times when my confidence in the prospects of a business, be it a Match Group or GitLab or something else, when I don't believe that much in the prospects, I downgrade that to a hold. I did that with a company called Enovix, um, and I recommended it at $14. Enovix, they make, well, I mean that's a different story, but essentially Enovix makes the batteries that will go into smartphones. They are pre-revenue business. That means they don't make any revenues. Essentially, they have a PowerPoint presentation and a lot of hope. So they believe that they'll be able to ramp this up in 2025. But midway during 2024, I downgraded that to a hold because I was like, okay, I own this, but I don't really feel that comfortable recommending it actively to people, And generally speaking, if I don't want somebody to buy it and I don't want to take that responsibility, I downgrade to a hold. And I say to people, I'm very transparent. I say to people, okay, I am looking for this XYZ. For example, with Match Group, I'm looking for that American Payers Group to kind of stabilize a little bit. And if it doesn't, it just didn't work out. It's fine. Like I had this vision for it, didn't work out. The figure that I really wanted it is for it to decelerate below 10%. Last couple of quarters, it's been approximately 15%. That has been the churn there. So it's kind of like, okay, it's not really what I wanted. I wanted to be a bit like PayPal. I wanted it to be, slightly more stable than investors were pricing in. That was the thesis of PayPal. PayPal has been kind of like, I recommended it at the back end of 2023, and man, it's been a long hold, and it hasn't really delivered. Obviously, delivered today, but hasn't really delivered what I was hoping for. So, is this type of situation where you are buying something cheap, but you kind of need there to be stability in the business. And with Match, I didn't really feel that it had that. And with GitLab, you know, when you're trying to price in a business that's on the path to inflect, okay, let me just rephrase. So inflection investing, the way that I see it, is when a business next year will make substantially more free cash flow than this year. So the business will make more free cash flow next year, more profitable business. But to get really like that typically is a good setup. But to get some real jazz in that return, you kind of need it to be better than people's expectations. Okay, that's the key, really. And when it doesn't happen like that, the stock gets hit hard. So GitLab was hit hard. Sentinel One a few months ago was hit hard on this. So you need it to be moving towards the thesis. And if it's not, I try and simplify my ideas to like really two variables: the customer adoption curve and really the amount of free cash flow that I think it's going to make next year. So if it's not really doing that, I know from my experience that I can do two things. One, which is very, very successful, is park it as cash. Cash is really, really good. And the second thing is that I know that there's always something happening in the market, so maybe it like takes a couple of weeks or whatever, but something will find. I'll find something. So I don't need to kind of restructure my mind to fit that business. It's okay to say, okay, hands up didn't work out. Uh, and I'm gonna come to this like when it doesn't work out a little bit more throughout the webinar. So on that aspect, I will just move forward. So the Olympic Games are on, and I kind of wanted to title this as like to get an Olympian performance, because there's a lot of common traits between what I see in the Olympic Games and what we're trying to do. And the way I see it is really about the repetition, and more importantly than the repetition, whether you're, let's say, jumping into a swimming pool or investing, it's that ability to stand up to the swimming pool or stand up to your work and try and understand businesses better, even when you don't feel like it. Because there are days where you kind of like, oh, you know what? I kind of like don't want to. Like, it's nice sunny day. I don't really want to do that. But that's when you get rewarded, is when you kind of come to the plate, refining your craft all the time, and and really like investing or like training of any sort, it takes a long time to see results, and you have to be to yourself self-motivated to, because there are periods when the market, everything is go go go, like things just work, it's just working, and there are times when you are right on the fundamentals and it's just not working. It's really not working. And just to be upfront and honest to you people, because you're giving me your time, I feel that I deserve to give you your respect and match that to my honesty. So Life MD is a business that I really, really feel like is undervalued, and it's not working. Like my vision for it and the share price seem to be going in different ways. So, rather than kind of like saying, oh, I got this, like, and putting my ego in front of it and saying the market is wrong, it's okay to say, okay, let's just see how things develop, because I don't want to be in a position where it's me against the market, because I know from experience that the market will win. So it's much better to try to have little attachment and spread your work across the portfolio. And this leads me to the second thing, which in investing is really important, is about having realistic expectations. I study a lot about compound interest and that kind of stuff, and I'm always fascinated to see the development of things over time. I'm reading a book by Hans Rosling called Factfulness, and I find it mind-blowing that it's taken us 10,000 years to get to 1 billion people in the world. 10,000 years. And in the next 200 years, we got another 1 billion. And in the next 100 years, we got 5 billion people in the world. And this is just compounding, right? And it's just crazy, to it. Obviously, there's different levers here, like the ability of people to have better education, so you have less deaths per children, and all that kind of stuff. But I find it mind-blowing, that kind of stuff about compounding. So about having realistic expectations, in investing, it's really, really cutthroat, because what I am trying to deliver to people is I'm trying to deliver to people what I believe is reasonable, which is a 15% return. Incidentally, we're up about 30% so far this year, which is better than the S&P and better than the Nasdaq. And the expectations of people is that we go through this earnings seasons and it's going to be like fireworks, you know? And I don't buy the argument that just because something is a small cap and it's underfollowed, that it's undervalued. I don't buy that. That's complete nonsense. And similarly, I don't buy the idea that hedge funds know anything more than retail investors. But what it appears to me to be is that hedge funds understand that this is a game where in reality you're trying to kind of aim for slightly more than 10%. And because they have this understanding, let's call it, quote unquote, knowledge, they have the stick-to-itiveness to stay with the game because they're trying to kind of get in around that ballpark. They don't give up when the market comes down because they recognize that what they're trying to do is that ballpark of slightly more than 10%. But a lot of retail investors kind of want, to get a strong return and it's like the stock's going higher and like, whoa, and it's a business. And over the course of 12 months, businesses don't really change all that much. And it's important to understand that share prices change as people's expectations change a lot, but the underlying businesses, they kind of move rather slowly. So it's really the job that I am trying to give and to explain to people is to simplify the strategy, to boil it down to one or two variables, really explain things. And along this path, I kind of wanted to highlight 4 tips. So first, and seriously, this is like probably the best thing I can offer you. Be selective when investing, okay? So just because things are moving around doesn't mean you need to have an opinion on that. It's okay to say, hey, you know what? I don't know. I don't know. Maybe it will be okay, maybe not. For example, I'm reading this book, 100,000, so it's the back of my mind. The number of people that are gonna be in Asia over the next 2 decades, which is not a long time, 2 decades, is astounding. There are going to be around like a serious number of people, like 5 billion people in Asia. Now, that means that the bulk of people that will be consumers will no longer be in the West, right? So this is important. It's not about trying to find those consumers in the West and selling them the newest upgrade on the newest phone. But there are a lot of people in Asia that are coming towards middle income, and servicing those customers is going to be a lot more interesting going forward. Now, I know from experience that in the market, it doesn't matter what insights you have. You need everyone else to recognize that too. So for example, in 2022, I was very much, and I am still very much, about uranium. And I was like, oh, I believe that there's going to be a lot of need for energy coming from data centers. And this will drive the need for a higher amount of electricity production, which will come from, I believe, uranium, because people are trying to decarbonize the energy source. I don't believe that solar panels are the solution for this. So I have an idea, and if you're too early with your ideas, it's the same as being wrong. Okay, so again, it needs to be selective, and your idea needs to be dumb. The dumber the idea, as in it does not overly complicated. You can summarize it down to like a couple of lines. That's generally, I believe, when it works out best. When you're saying, oh, it's doing this and it's doing that, and you can add loads of stories, it doesn't work out. Now, along these lines, and this is frustrating, I recognize it, it's okay to do nothing. There are periods of time where things don't work out and you don't find something that's particularly attractive. So, it's okay to just, do nothing, stay in cash. And, things move rather quickly, and, it can be like 4 or 5 weeks, and then, there are a few things coming along. And lastly, I wanted to mention that even though for long periods of time, it doesn't seem like in the market valuations matter, it matters. It matters. It really does matter. And, you know, for all intents and purposes, the PayPal investment hasn't really worked out how I felt it was, but because I was recommending it while it was cheap enough, it seems to kind of be moving in the general ballpark. But I question whether, you know, I was right at the time, you know. So it's like up slightly more than 10% since I recommended it, but it's not the greatest investment that I've made. So having a good valuation forgives a lot, but you don't only rely on the valuation. So yeah, that's pretty much all I have to say for today on that. I'm happy to open it up to some questions if anyone has any. If no one, oh, good, George. Yeah,
You know, there's talk I hear of sometimes a stock is not in favor.
yeah.
Is there such a thing as, well, I mean, there's momentum of like Nvidia, but is there certain stocks where, you know, there's a bias and it's just not fair how it's being treated?
Yeah, I think that the market loves to kind of break down things into off and on. You know, it's like categorize things. It's either like it's either working or not working, and you know, like you can see for yourself in our discussions that we've had throughout 2023, quote unquote, I believe software stocks have been quite out of favor. You can look to, let's say, some of these kind of names people may or may not know, like UiPath, MongoDB. There was a business people used to really like called Atlassian. Another one's called Asana. So the kind of software customer relations like Salesforce, you know, these kind of software businesses appear to be out of favor in 2023. Sorry, 2024. Sorry, apologize, 2024. Particularly relative to last year. So I don't know if there's a particular other way to look at it apart from the share price moving down, but I feel as well that the market kind of runs like a pendulum. And I've said this before, businesses don't go up. The underlying fundamentals of the business don't go up in a straight line. It's a cycle, right? So there's like a lot of software adoption, and it kind of expands for the whole total addressable market. And then, you know, there's a period of digestion where businesses don't really need that much software, and it kind of contracts, and that aspect goes out of favor. So it also makes for quite interesting fertile ground. So you know, it's on top of the mind is CrowdStrike and, you know, SentinelOne. And at times, these kind of businesses lose enthusiasm and their share price kind of lags for several months. And in my experience, provided that the fundamentals remain relatively strong, I think that's kind of interesting too as a setup. So this time last year, August, kind of, I recommended Uplovin, and for 5 months, this share price was dead. But the fundamentals kind of were doing stuff, you know? So I feel like that, you know, like with PayPal as well, it's like the fundamentals are kind of ticking along, but it's kind of like a fintech, and people are like, it's like, you know, it's a boring business, and it used to be like a crowd favorite, but now there's a lot of competition and this and that. But if you actually look at the fundamentals, they're ticking along, you know. So I feel that you know, more often than not is a fertile ground. Now, just caveat that further. Investing is a really, really tricky game because you don't want to be too early. That's a mistake I made at PayPal. You know, I kind of got too early in there, and if it's underperforming for a period of time, it's like your thesis hasn't worked out. So it's difficult. You don't want to buy necessarily what's in favor, but it needs to be kind of ready to move quite quickly, and it's obviously that's really tricky. Yeah, it's like it is tough, right? It is really tough. I don't have a good answer for that.
Well,
That's a great question, because that's
thank
what
you.
we're trying to do, right? That's really what we're trying to do.
Right.
Like,
Right.
ideally, you're trying to buy something like a PayPal when it's, let's say, like 3 months away from a day like today. That would be like, but it's impossible, you know? So you're just having to kind of sit around for a long time and you feel like an idiot. And that's what the market is amazing at, making you feel like a complete idiot. Because everyone is like, oh my God, like Nvidia, and you're like a schmuck because you're not in Nvidia. And you feel like you're left behind. But that's the game, right? The game is to try and declutter all that perception, all that noise, sorry,
but also, if it makes you feel like an idiot, you must feel like a genius at times when it takes off. So that swings both ways.
Yeah, there's what's his name? I forgot the name. It was an author. Just missed it. Someone will remind me. Thinking Fast and Thinking Slow. Amos Tversky and Daniel Kahneman. And they describe how the pain of losing, let's say, $5 is substantially higher than making the gain of $5. When you lose something, like if you're walking down the street and you kind of $5 falls out of your pocket, you're like, oh my God, where's my $5? Like, but if you pick up $5, you're like, you don't feel that much about it. And the same when the stock kind of goes up, you kind of like, you don't kind of like, it's okay. It's like what you're hoping it was going to do. But when it comes down, that's really kind of where you feel, and you feel like that pain. And as a consequence of that pain, you are duped into believing that you need to react. You need to do something because somebody knows something. But it's not like that, and it's better, I believe, to have a strict holding period. This works for me because of my personality. I'm quite an agitated person, and I feel like if I put these barriers against myself, it's helpful because I often go back to chess. I'm not a very good chess player, but I do like playing. And if you kind of keep losing the queen like on the fourth move, like at some point you just stop losing the queen on the fourth move and maybe you lose it on the seventh move. You've already improved a little bit. So it's like that, you just try not to do the same mistake all the time. And it's like we're talking about being an Olympian sport, like you just beating on your craft. At some point, it kind of like, it becomes slightly better because nobody, whether you're Buffett or whatever, nobody was born being successful in this game, right? It's hours and hours and hours and hours and hours of beating on the craft. And it's like, it is, you having to put a lot of blood, a lot of sweat, a lot of tears along the way. And if someone else is putting more blood and more sweat in the game, they deserve to be rewarded more, yeah.
Thank you.
Hi, Michael.
Hi, hello, hi.
I had the question just generally on your process. I'm still fairly new to this community.
Cool.
And I think earlier on today, you just mentioned a little bit about when you talk about inflection investing, you're thinking about companies that will probably have a disproportionate amount of cash flow 12 months from now.
Yeah.
Do you have a certain process that you go through to identify like a short list of companies to say, okay, these stocks have been maybe misunderstood by the market and we think that it's significantly undervalued but it's still going in the right direction. So are there certain metrics or indicators that you look at to say, okay, this could be an opportunity to consider?
Yeah. Harry, pleasure to meet you. Thank you so much for the question. I really appreciate you coming on, and thank you for your support. The question is really what you're asking, is there any kind of screener? And I'm going to disappoint you. And I'm sorry, I wish we could have been friends, but there is none. And I get this question all the time. That's why there's no point footballing around. There is no screener. This is just hard work. But for me personally, I get up and I grind and I look through as many companies as I can in a day, and I keep going at it. But I'm looking for two things. I'm looking for the customer or user growth. Okay, I don't necessarily need it to be growing up very fast, but I need it to be stable and somewhat predictable. For example, something like Samsara, I'm expecting for the customer to be growing at, let's say, 10 or 15%. I kind of need that ballpark. And then I don't want any kind of shocks. Something like a PayPal, I'm not expecting much. 2%, 3% in that ballpark. But I don't want it to be seeing it shrinking like I did with Match. So it's relative to what the expectations of the market are. But the customer adoption of the user growth, ideally, some kind of figure that tells you what people are actually paying for. Obviously, if you have a business, let's say, not that I have this business, but if you have a business like, even let's say I do have Meta, okay? So with Meta, you're looking at the number of users that are on that platform per day. No one's really necessarily paying to watch an advert. But I want to see that. How stable is it? Because the more stable it is, the more predictable next year's free cash flow will be. That's the first metric that I'm is like really, really important. The second thing that I want to see along these lines, I want to see that over the course of several quarters, the free cash flow is somewhat predictable. Ideally, it's coming up, it's increasing to becoming a stronger company, but I want it to be able to be relatively predictable, because there are some businesses that have like 2 or 3 quarters that are really, really strong and everyone is singing and dancing, and then it just implodes. So you don't want that, okay? That's not a business that's going to fetch a premium on the stock, because when you're buying, it depends on the business, but when you're buying a business, part of the inflection is that people have higher expectations of the future free cash flow of the business. So that's a big mouthful. But let's say, for example, because I wrote about it today, AppLovin, the free cash flow is not a large multiple. I understand why, advertising stocks typically don't get a very large multiple. And in the case of AppLovin, it does have quite a bit of debt. So if they pay back a portion of that debt, and the free cash flow continues to come up, it might maybe trade, let's say, 17 or 18 times free cash flow. In which case, you get more free cash flow, and that multiple is higher. So you get like double jump, and it kind of, you get a nice little return there on your investment. So those are the two metrics that I think are really, really important.
Thank you. That really helps.
Sorry, I have a question here. 1 second. Just a second. So the question is about how I got this number for AppLovin of 1.9 billion in free cash flow. So generally speaking, I try my hardest to have a very conservative estimate. I have found over time that my free cash flow estimates are on the right ballpark. And if they are, it kind of gives me confidence to keep overlaying that. Now, some companies give you for what the free cash flow is going to be this year. So you try to have some kind of reasonable estimate of what it could be next year. So with AppLovin specifically, we don't know that because they only guide for Q2, so which is like coming next week. So what I did is I took Q2 and Q1, and I looked to the previous year, and I kind of said, okay, this business is growing a lot from its software business, which is a really high margin business. So without any heroics, if it's growing, let's say I felt that it could get to about 1.5 billion this year. So with some optimization, and if I believe, which I do believe, it can be growing next year, uploving by about 20%-ish. With some operation, with some scalability, it could grow by 25% next year, the free cash flow. So that's really what I did. Nothing very convoluted, nothing too dramatic. And I just try and update that figure with every 90 days when the company reports the results. Say, okay, like, am I still in the right ballpark? Or do I need to kind of revise it down, revise it up? And I'm very upfront and clear with people and say, okay, this was where it needs to be up, or I make it clear so that people understand, because I think that if people understand the investing process and what the stocks are, they have more conviction to hold. And that's really where the money is made. The money is made in the sitting on your hands. It's not really in the buying or the selling. It's just really just waiting, really, is the long and short of it. Yeah. Does anyone else have any questions they kind of want to ask? Okay. If no one else has any other questions?
Hi, Michael. I just wanted to ask you, what's your time frame for PayPal? What do you expect? Just this coming summer, 2025, or?
Yeah. So I feel that I'm hoping that I will see people get more bullish around this, because as far as fintechs go, to the best of my knowledge, nobody's making this amount of free cash flow. Nobody's making 5 billion. 5 billion is a lot, particularly for a business with a market cap of approximately 65 billion. That's a lot of free cash flow. That's a lot, particularly if you look at their balance sheet. So they have 18 billion, including investments, but $18 billion just laying on their balance sheet as cash and investments. They have 4 billion of debt, okay? But altogether, 14 billion of cash and making about 5 billion a year. That's mind-blowing to me for a business this cheap. So I feel that it can easily get to about $90 to $100 as the price target. But I recommended this business in November 2023. So at the stock that we're talking about now is PayPal, PYPL, PayPal. So I feel that when I get to November, I'll have a bit more visibility at that point where it makes sense to kind of underwrite it slightly further. Generally speaking, I like to kind of recommend my stocks and kind of see where they are after a year, because I know that if the thesis is taking too long to work out, I don't want to crush myself because it didn't work out. If the thesis didn't work out, there's no point kind of saying, oh, it will work out, because it won't. Like, don't overcomplicate things. But if I see that, like, for example, with Palantir or HIMS, it's like clearly working, people are kind of really coming around to it. It makes sense to just expand that time horizon slightly. Now, I don't want to expand it forever, because either the thesis works or it doesn't. You have an idea of where the business is going to be next year. And if the business is very far from where you thought it's going to be, there's no point you kind of, making a drum and kind of singing a song about it. It just didn't work out. So in the case of PayPal, I would like, hopefully, by November of this year, to be coming closer to that $90 target, so that I can say, okay, yeah, it can probably get to about $90 to $100.
Okay, thank you.
Thank you so much. Thank you. If anyone else has any questions, I'm happy to take them. Okay. Thanks, everyone. Really appreciate the turnout. Thank you very much, everybody. It's really kind of everybody. And see you next week, hopefully.
Thank you.
Thank you. Thanks.
Okay.
Thank you.